Okay, well, let's go ahead. We'll get started. My name is Deb Weicker. I will be moderating this evening's webinar. Before we get started, I just want to go over a few housekeeping items. If you are experiencing any audio issues, we do have a call-in number up on the screen right here, so I'm going to leave it paused for just a minute for people to see that. If they can't hear me, sometimes it's better for attendees to dial in with a phone versus using their computer. Next, all attendees will be muted during the webinar. However, if you have any questions, please feel free to utilize the questions panel, which is typically located on the right-hand side of your screen. We will pause throughout the webinar to read and answer your questions. And finally, this webinar is being recorded, and a link will be published on our website and will also be emailed to you with a survey at the end. So let's go ahead and advance. Before we get started, I'm going to introduce to you our presenters for this evening. We have Kathryn Schmitz. She's Assistant Vice President Retail Banking, who joined BankFirst in February of 2016. She has been in the banking industry since 2000 and a mortgage loan officer since 2004. Kathryn has spent her lending career working with many different home loan programs, including government programs, first-time home buyer programs, and has really assisted a lot of down payment assistance options with a lot of her customers over the years. She has made exceptional customer service, effective communication, and dedication to her customers the backbone of her business, and is devoted to helping her customers achieve their dream of home ownership. Kathryn has a bachelor's degree in business administration from UW-Green Bay. Next, we have Amanda Sitkiewitz, Vice President, Retail Market Manager. Amanda began her career at BankFirst in September of 2012. She has over 15 years of banking experience in the Lakeshore area. She currently oversees the bank's 5 branch offices located throughout Manitowoc County, as well as manages the bank's 8th Street flagship office. Amanda has established many relationships with local real estate professionals and takes pride in being able to confidently guide her clients through their transactions, whether that may be their first home purchase, their last home purchase, or the construction of their dream home. Amanda has earned her Bachelor of Arts degree in Spanish from UW-Green Bay as well. So Amanda and Kat, I'm going to go ahead. I'm going to give you guys screen control, and you can go ahead and get started when you're ready.
All right, great. Well, thanks everybody for joining us tonight. We're looking forward to your questions as a large part of this, so please feel free to type those in as we go. We want to know what you want to know. So to get started, the first slide here is kind of our what our presentation will cover tonight, and also your home buyer to-do list. So these are the things that you can expect as you go through the process of buying your home. And we'll walk you through these throughout the presentation. So we're going to save for money for this house. We're going to make sure our credit score is good, figure out how much we can get approved for and how much we can afford. We'll work with realtors to make the offer, and then we'll guide you through that step, what happens in between before we get to closing. So that's a little bit of the information that you can expect tonight. And we will jump right in here with our first number on the to-do list. Number one thing you need to do, start saving. So let me see. Here we go. Whoop. Okay. So priority number one, when you have decided you think you want to buy a house, you are ready to go, start saving some money. We'll need things like a down payment. You need to pay for your closing costs. You need to buy some homeowners insurance and prepare to pay for real estate taxes going forward. So there's a lot of things that go into home ownership right up front that you need to be prepared for. One thing that we coach people to do right now is, what are you paying for rent, and what do you think your new mortgage payment is going to be? So if you have a $700 rent payment right now, but you think you probably want to buy a house that'll cost you in the neighborhood of $1,000 a month, Start saving that extra $300 every single month. Figure out what that feels like for your budget. And maybe you do this for 6 or 7 months, and then you've got a nice little savings cushion started as well that can go towards your down payment, or maybe buying your first year of homeowners insurance, pay for your home inspection, things like that. So there's a number of things that you'll need to save for. And if maybe you have no rent right now, you're living at home, whatever that case may be, same concept. You're living rent free, you don't have a monthly payment, pretty soon you're going to. So start banking that money regularly and make sure it's comfortable for you. And bonus is you have a nice little savings account to work with. All right. Credit score is going to be a next big issue that lenders will take into consideration, and Kat will give us a little bit more information on that.
Okay, so improving your credit score, or at least making sure that your credit score is where it needs to be. There's a lot of good applications, apps out there, websites. Credit Karma is probably one of the more popular ones out there, where you can kind of turn just to gauge where you're at on a credit scale. So credit scores range from about 350 to on the low side to roughly 850 on the high side. Skipping everything and going right down to the bottom, why do you want a high credit score? Because you're going to get the best rate possible. The higher your score, the lower your interest rate. So you want to, if you can't check one of those sites or apps, and a lot of my customers, the first time they even see their credit is when they come to see us, and they're going through a pre-qualification or a pre-approval. So at that time, a lot of times it's the first time that they're looking at their credit. So if you find yourself in a situation where you need to improve your credit score to get a home loan, the very first thing you want to do is stay current on your bills. The worst thing you can do to your credit is make a late payment. So staying current on bills, and we all know that life happens, and some of us might go a couple days past our due dates. That's not the end of the world, but you want to, at the very least, make sure that you're not going 30 days past due on any bills you have. The next one you want to be careful of is don't make any major, or try not to make any major purchases. When you are gearing up to make what is going to be the biggest purchase of your life to this point, meaning a house, you don't want to go out and make any other major purchases. So make this, if this is your goal, it needs to be the most important. Canceling or keeping long-standing credit cards active. And as you'll see in the next slides that I get to, it's very important to keep accounts that you've had open for a number of years active. You don't want to be closing out, and I will get into the differences between closing credit cards, which ones you want to close and which ones you might want to keep active, but you definitely want to give it some thought before you just willy-nilly go and close credit cards that you have out there. And where we kind of started in the beginning of this section, monitor your credit. Get on, if it's not Credit Karma, we're all allowed to have a free credit report, every year at annualcreditreport.com. So just knowing what's reporting out there, even if you don't get a score attached to it, is definitely a good place to start in the home buying process, because it seems every year credit scores and credit becomes more and more important and plays a more major role in getting any sort of approval for programs that are out there. So now we know that it's important to have a good score. If you aren't sure, or maybe don't have the best score, what's important in improving that score, but what actually makes up a credit score? So there's 5 categories, if you will, as to what goes into the score that you ultimately have. And they're kind of ranked in order from most important to least, but in reality, they're all important. So the first one is your payment history. Do you make your payments on time? Like I said before, life happens. We all might go a couple days past our due date, and while that may result in a late payment fee, it's usually never reported to the credit bureaus as late unless you're a full 30 days past due. So it's very important to pay your bills on time. Making one late payment may not seem like a big deal, but I've seen it drop individuals' credit scores 20, 30, 40 points, and it drops overnight, and it takes a very long time to get it back up there. So payment history, very important. 2, outstanding balances versus amounts owed. This is in particular to credit cards. You want to be very conscious about what you owe on your credit cards versus what you can spend, what your limits are. The bigger that gap, the better your credit score will be. It's called the utilization ratio, and you may hear me say that in a couple of slides as well. But we're basically looking at what you owe versus what you can spend. So if you have 3 credit cards, each with a $5,000 limit, so you can spend $15,000, but you only owe, say, $4,000 out of that entire 15, that's not too bad of a utilization ratio. That gap is pretty adequate. But you also need to look at the individual cards. So if you owe $4,000 on one of those cards, and remember they're all $5,000 limits, you essentially have maxed out that credit card, and that can kind of drop your score. So you just want to be very conscious and very aware of what your limits are and what you're charging. They say the golden rule is about to have a 30% utilization ratio. So if you look at what you can spend on your credit cards, add up all your balances, or excuse me, add up all your limits and then add up your balances, you want those balances to be 30% or less of your limits. And you can see the chart, I really wasn't referencing it, but about 35% of what makes up your credit score is that payment history. So definitely the most important. 30% of your score is talking about those credit cards and your utilization ratio, what we just got done talking about. Next down the line is length of credit history, which accounts for about 15% of what your score is. So length of credit history is just going to come with time. The sooner you can start building credit, the better. But someone who is in their early 20s is just not going to have the kind of history that someone in their 40s is going to. So length of credit history, very important, and it's just going to come with time. And types of credit accounts for 10%, having that good credit mix. Having just one credit card may work for you, and maybe that's all you want, and that's fine, but it's just going to take longer to build your credit. You kind of want to have a good mix, maybe a credit card or 2, an auto loan if you're recently purchased a vehicle, and then eventually building up to what we're talking about today, getting a home loan. Credit cards don't have to be used all the time. I have a lot of customers who come to me saying they are credit card adverse. They don't like credit cards, they don't want it. Unfortunately, it's a very good way to build credit. And if you use them responsibly, maybe just get one credit card, use it to fill up your tank of gas every month, once a month. That's going to start building credit. The more credit you have, the faster you can build it. And last but not least, for the last 10% of your score is credit inquiries. So you want to be very conscious about who's pulling your credit and what you're applying for. It seems like it's not just during the holiday season, but all the time you're at the register and someone's asking you if you want to open up a card and save 10% on your purchase today. So while we're not saying don't ever do that, just be conscious and make sure that if you're doing that, it's for a card that you really want. Because once you say yes, you may get that discount at the register, but that doesn't necessarily mean that you'll get the card, and now that's a hard credit inquiry on your credit, which can certainly drop your score a bit. So just make sure that when you're having credit inquiries, you're being very conscious of it and doing it for the right reasons. So those are the 4 factors that make up a score. To kind of piggyback off of that would be the last slide that we're going to talk about with credit. 5 credit mistakes, and you'll see that these definitely overlap each other. So the 5 credit mistakes, closing credit card accounts. So again, you just want to be very careful when you're closing credit card accounts. Try to keep the ones that you've had for a long time. Try to use those regularly. It's not only good for your credit to use a credit card appropriately, but it's also that length of history that you're trying to build. Closing a credit card that you don't really think you need, you might only use it once a month, but you've had a 4 or 5 year history on it, can actually work against you when it comes to credit scores. But that's not to say that those inactive accounts, those credit cards you haven't used in a long time, those are a very good idea to close. You don't want to open yourself up to fraud. It's just maybe keeping a few small credit cards open that you use regularly. That's important. So don't close them. if you use them regularly and they have that, or try not to close them if they have that long credit history. Missing payments, I think we talked enough about that in the last slide. Again, don't worry about a couple days. You may get a late fee, but certainly we all know life happens. It's that 30 days that you want to absolutely avoid. High revolving utilization on credit cards. So there's that utilization ratio that I was talking about before. So just be very conscious as a whole and also per card that you're really, really trying to keep that balance that you owe at 30% or less of your limit, especially when you're in that credit building phase. Excessively applying for credit, piggybacking off of the last part of what the last slide was talking about. Just be very conscious about the credit inquiries that you're making and that they're being used for the right reasons. And then settling accounts. Unfortunately, again, life happens. You may end up with a medical collection or something else that you have to settle, but this should definitely be a one-time event and not something that's part of your regular payment history.
I think it's important to note too, there was asterisks on the last slide that mentioned there are lots of different credit reporting models. So when you're looking at Credit Karma, for example, is the one that we see all the time. If your Credit Karma says you have a 720 score, that's great. But that doesn't mean if you walk into your bank and have them pull your credit, that it's going to be 720. We typically use a different model than Credit Karma does, and that's very normal. Pretty much every bank does. There's lots and lots of different models. Your car dealership will use something different than your home loan lender, than your Kohl's credit charge credit inquiry gives to you when you do those types of inquiries. So things like Credit Karma are a really good ballpark tool. What if you get your credit score on your Discover card, things like that? It's going to put you in the range, but ours might be a little lower, ours might be a little higher, but just know that Credit Karma is not the end all be all of your credit score when it comes to what a lender may find.
Absolutely, that's a great point. And a lot of times I will tell people that Credit Karma is a good tool, but it's just that, it's to kind of gauge whether your scores are going up or down. Not that what Credit Karma says is going to be what we say or any other financial. Good point.
Great. We were going to pause here just for any questions that have come in so far, and we don't have any so at this point. So again, if you have any questions, feel free to type those in the questions panel over to the right. Otherwise, we'll keep going.
All right. Switch here. Here we go. All right, so next up, after we pull your credit, we can determine that you've got a good enough credit history that we can move forward. Things are paid as agreed. And something you may want to even do before you come into the bank is to say, what can I afford? Where am I? We get a lot of those phone calls. I just don't know where to start. Pre-approve me for whatever you can pre-approve me for. So we've got the link on here is a tool that's on our website. There's all sorts of them on the internet that you can use, and most of them have pretty much the same percentages and such in here. But ours is nice and simple. I used it just before this presentation just to see what it told me, and my eyes bugged out of my head a little bit. So the thing that you need to know when you're getting a pre-approval in this manner is when you're looking at these calculators is we're just doing the math. Okay, we're saying you make this much, these are your debts. Based on industry standard ratios, you can afford this much. We're not taking into consideration that you might have $900 in daycare costs, or that you might have to pay, medical bills on a monthly basis. Those are not things that we factor in. That when you sit down with us, we'll certainly talk all about that and say, okay, here's what the number is, but now let's say what's more realistic. So from a lender standpoint, we're going to show, if you look at these boxes on here, we're going to want to know what your income is. We're going to check your credit to see what your other monthly debts are. In addition to anything that shows on your credit report as a liability, we'll ask you about things like other properties that you might own and any expenses related to those. We'll ask you if you have any child support payments or spousal maintenance payments or things of that nature that you're obligated to on a monthly basis that we maybe wouldn't find on your credit report. So we'll dig into some of that. Things we don't necessarily ask for that you should consider is utilities, daycare, your other, bills to live on, your cell phone, your groceries. Those are types of things, those household expenses don't get factored into this equation. So as a rule of thumb, it's 28 to 30% of your total gross monthly income. So prior to taxes is where you want to put a cap on your housing expenses. So that's including the loan payment that you'll make to the bank, along with your real estate taxes and your homeowner's insurance. So we'll work with you to factor in other debts, come into this number. Now, if you have a lot of other debts, you maybe can't do 30% of your total monthly income on a mortgage payment. So that's just kind of a rule of thumb. It's a really high number for a lot of people, though, when it comes down to realistic budgeting. So this is a good starting tool. And then from there, we might work into what your comfort level actually is. All right. You want to talk a little bit about the pre-approval process?
So,
Before you guys continue, we do have one question that involves the credit.
Okay.
One question that came on is, how frequently is requesting a credit increase appropriate? So a credit increase with
on a credit card?
credit card, I'm assuming, yes.
Credit limit increase?
Yeah, that is, actually, it can be a great tool to widen that gap between what your balance is and what your limit is, therefore making that utilization ratio look that much better. So that's actually a great question. I don't know that there's necessarily a perfect time or a perfect amount, or the number of times matters so much as if that's something that you can do. Now, I guess be careful, because when you do that with your current credit card company, they're more than likely going to pull credit. So, but it can be a great tool, and I would definitely suggest, if you can, checking that out with at least one of your credit cards if you're looking to make that ratio look a little bit better.
Yeah. It is something that we actually suggest from time to time to different borrowers. If we have maybe a younger borrower who got a credit card with a $500 credit limit in college when they had no credit, and just haven't gotten another card since. Well, they might charge $400 on it. Do they have a lot of debt? No. Is it maxed out? You bet it is. So that's definitely a situation where you might say, hey, you've had this card for 4 years now. Why don't you give them a call, see if they'll increase your limit. Even if they get a $2,000 limit, now they have $400 used against a $2,000 limit. So like Kat said, it can make it look a lot better. It's just a matter of whether it's helpful. It doesn't pay to do it just to do it if you don't need to,
Right.
But if it'll help, definitely a good tool.
Yep, great question.
Well, while we're on the topic, we have one more, or two more questions actually. How long does a late payment take to clear? And once it does, how much would my score increase?
Another great question. Unfortunately, it's kind of a difficult question to answer, quite honestly. It is going to, as far as how long it's going to take to clear that late payment or to get your score back up from the damage that was done, truly depends on where your score was when it happened. Where your score was and overall credit history was when that late payment may have happened. It determines maybe how much the score dropped, and then how long it's going to take to increase. To To be honest, it's a great question, but it's kind of one of those, nobody can really tell you for certain, oh, it's going to take you X amount of weeks or X amount of months to have that off of your report or not have an effect. All we can really say is the more time that has lapsed since that late payment, the less of an effect it'll have on your scores.
In general, though, they stay out there for a while. I mean, I might pull somebody's credit today and it'll show me that they paid a credit card late in 2016.
Mm-hmm.
Does it really impact their credit anymore? Probably not, if everything else has been clean since then, but I'll still know that it happened. So Kat's right, it's a matter of time, but it's not falling away altogether anytime soon.
And one more question, does paying off a loan early hurt your credit score?
These are great questions. It can, if it's your only trade line that you have reporting, I will suggest to my customers to not pay it off early. It's only helping your credit if you're making on-time payments and you're able to make those payments. Now, if it's a loan that is almost done being paid off and you have other loans out there and maybe, you know, one or two other credit cards that are working towards your score and keeping that going forward, then I don't think prepaying is as big of a deal. But if that's one of your only trade lines, I would suggest letting it run its course and making all the scheduled payments.
A lot of people they're under the impression that paying it off early is this golden thing on their credit that says, oh, look, I paid it faster than I had to. Well, that's great, but you also just stopped any credit history you were building on that trade. So like Kat said, if you've got multiple other things going on, not a big deal. If that's it and you're counting on it to build your score, really big deal. Anything else, Deb, at this point?
And nope, that's it.
All right.
Okay, so let's jump into mortgage pre-approval. We just want to make sure we get through everything here tonight. So the big thing, what you've been working on your credit for and what you've been monitoring your credit for and what you've been playing with numbers and budgeting for, now it's time for mortgage pre-approval. So go and sit with a lender and see what different programs are out there, what you may qualify for to solidify maybe some numbers that you've been running on your own, decide which program is best for you. And in the next slide here that we get to in a second, I'm just going to touch on a few of the more popular loan programs out there, many of them geared towards first-time home buyers. But for pre-approval, it's almost, I would say, necessary nowadays. A couple, maybe even just a year or two ago, it wasn't as important, but now you almost need it just to go look at a house with a realtor. And there is a difference. I just kind of want to point this out. There is a difference between pre-approval and pre-qualification. The terms are used interchangeably, always have been, but mortgage pre-approval is when you go and sit down with a lender and actually show them your income and your credit. And now we've reviewed it and we're actually issuing you this pre-approval letter. A pre-qualification is also good, but it's where we're just looking at your credit and we're determining, okay, well, based on what you verbally told me your income is, and based on what I see on your credit report, here's what we think we can do. So big difference. And I think, especially over the course of the last few years, the trend has been towards really needing that pre-approval letter, really letting a realtor and a seller know that you have done some serious homework and been to a lender, and barring a few other things, can qualify for a mortgage. We do have a website listed right here that I highly suggest you check out. There's a wonderful home loan toolkit that it's this presentation times 10. It's a really good toolkit to get in there and kind of telling you what to expect. This is just a high level overview of what you'll find on this website. So we suggest going there, and then the documents necessary for this pre-approval, those income documents, we are typically looking for your last 30 days worth of pay stubs, your last 1 or 2 years of W-2s. You should just plan on 2 years. Every lender is a little bit different. If you're self-employed, we're looking at tax returns for the last 2 years and bank statements. But for pre-approval processes, we're really wanting to look at that credit report, which we pull, and then those income documents that I mentioned. So once you have those income documents gathered and you sit down with someone like myself and Amanda, we're going to be running numbers and talking about all these different loan programs that are available out there. And again, this is just an overview of what is available. We could probably talk a lot longer just on this slide alone. So the more popular loan programs that are available out there are your conventional loans. So these are the loans that you see advertised on TV, on our website, on anyone's website, where you can get a 10, 15, 20, 30-year fixed mortgage at a really nice, attractive interest rate. These conventional programs can be done with as little as 3% down. Again, we could go on forever about the differences in down payment and private mortgage insurance and really get into things. But just know that there are some really nice programs out there where you can get by with as little as 3% down. A lot of these programs, especially the first-time home buyer programs that we talk about here briefly, are income-driven. They're not only income-driven, where the household or sometimes the borrower can only make so much money, but they will also require some sort of online home buyer education. Doesn't necessarily have to be in person. Most of it is pretty simple and online, but it's still a requirement. On the conventional side, there are gift and grant funds that are out there available. Again, very much income driven. You can only make so much a year to apply for these. We offer one in particular as well. And then, in all of the counties that we operate in, there's usually some sort of housing assistance programs that we're knowledgeable and can refer you to as well. Then moving over to the VA, the federal VA. So that is very narrow in who qualifies. So it's for active military and veterans alike. It's a wonderful, wonderful program. It's a no money down program with 15 and 30-year fixed products available. You do have to be honorably discharged, and you also have to you're required to meet certain timelines for the service. But it is a wonderful program. It's got lots of other features that are great compared to some of these other ones, but it is, of course, just open to active military or veterans. The next one over, USDA. So this is another pretty awesome program. It's no money down. It is for, generally speaking, there is a website that we can go to and that you can actually go to yourself to see if a particular property qualifies. But it's generally for properties that are in communities with 20,000 or less in population. It is, you don't have to buy a farm, even though it is backed by USDA, United States Department of Agriculture. It is for not farming at all, actually. It's for single family homes that are not income producing, but that are in those rural areas so that we can kind of build up those rural, smaller communities. So wonderful program. If you can find, and that also has income limits, but they're very fair income limits, I think. And then the property just needs to be in a small enough community. And in a lot of the counties that we operate in, those are just outside of your bigger cities. You don't have to absolutely be out in the sticks to qualify. So it's very nice. Again, no money down program. The fourth and last program that we just want to touch on here briefly is WIDA. So WIDA actually used to be just for first-time home buyers. Now you don't necessarily even have to be a first-time home buyer, although the requirements and options are different between first-time home buyer and not first-time home buyer. So WIDA is typically has always been a 3% down program, although they have programs within themselves that we offer that give you a loan for that 3%. Like a program that's geared mainly towards first-time home buyers. They do require that home buyer education. It's online, it's simple, you do it at your leisure, it's free. And then there are income and purchase limits also with WIDA. So again, like I said before, a lot of these first-time homebuyer programs are income driven. You can only make so much to qualify. USDA is pretty income driven, although I feel the income limits are pretty high. WIA is income driven. Federal VA is not, but it's very restrictive on who qualifies. And then conventional is both non-income. There's some programs with income limits and some that don't have any income limits. So very wide range of options. And like I said, even within these 4 different programs we overviewed, there's a lot of different features within each of those.
The type of property that you're looking to purchase definitely will play a part too in what loan program we might steer you towards.
Right.
Most of these no down payment, low down payment options are for single family homes. We'll often see people that want to either, buy a duplex with the theory that my tenant can pay most of my mortgage, or they buy a, upstairs, downstairs type of a duplex and they say, I'm just gonna occupy the whole house. Technically, that's still a 2-family house, even though you might just have 1 family living in it. So that's something to consider too, because you might get a pre-approved for these things with a single family home. And then if you go back to your lender and say, oh, I found this really great 2-family and the upstairs tenant's gonna pay for half my mortgage, and it sounds really good, but we're gonna say, oh, I'm really sorry, but now you have to put down 15% and not 3%, depending on the program that you've been qualified for. So just communicating with your lender what you're really looking for. Of course, we'll ask those questions up front, but just know that most of what we're talking about and gearing this towards here is a single family home purchase when we're offering these low to no down payment loans.
That's a great point.
All right. Yeah, so Kat touched on this, but just to reiterate what the bank will be looking for to get started is kind of the basics, right? We want to see how much you make, especially if you have bonuses or commissions or tips or anything of that nature that might not be as stable of an income as somebody just working 40 hours a week at $20 an hour might have. We might need a little bit more information. We might need a year-end pay stub if you're counting on overtime, because we need to document how much overtime you've historically made. So this is the very basic general thing that we'll ask you for, and then depending on your situation, we very well could be asking for a little bit more to back that up. So just things to be prepared for, and also things to be prepared for to be asked to be updated throughout the process. So if we ask you for a paycheck stub today and you make an offer on a house next month that you're going to close on in the middle of June, the paycheck stub that you bring me now in the middle of March isn't going to cut it 3 months from now. So just be aware that bank statements, paycheck stubs are things that often need to be updated throughout the process. So don't shred all those. Keep your hands on those and keep them handy as you go throughout your loan process.
Absolutely. And those tax returns definitely will be needed for any self-employed borrowers.
All right. Is this me? I think so.
Yeah.
So choosing a realtor. If you are looking to purchase a home, sometimes folks come to us already have a realtor. Maybe the realtor sent them here. Maybe they're just in that pre-approval process of what can I buy? How much can I afford? So if you haven't already done this, we've always got a wide network of people. If you're looking to do a for sale by owner type of situation, that's certainly something that we can work with as well. We caution people about writing their own contracts. That's always a very scary thing for us, for you, for your own safety. But we certainly can help you out with realtors, real estate attorneys and things too. So at this point in the game, you've figured out what you can afford. You've gotten pre-approved. If you haven't found a realtor to show you some homes, now is the time in the process where you do that step. All right.
Now comes the fun part, going on tours and visiting homes and doing walkthroughs and trying to narrow down your choices. So always a good idea as you're looking at homes, making or taking photos of them, making notes. What are the pros, the cons, creating a home shopping checklist. What are your must-haves? What are your needs? What are your wants? What are your, oh, we don't really need this, but it would be really cool if we had it. Unless the perfect home comes along, which sometimes it does, you may have to give up something on this side of the equation to get something on this side. So when I was shopping for my house, I had a shopping checklist of something I absolutely had to have and something that I could live without if the right one came along. The neighborhood. So someone told me this before I purchased my last home, and I thought it was brilliant. Never thought of it before, but in the neighborhood that you're looking to purchase in or where you find that perfect house, go visit it during not only the day, but also at night to see what the lighting is like, the traffic, the noise, the neighborhood in general, how it operates at night, and then also during the day. Drive through it, walk through it, but I highly suggest that being very, very important. Test your commute to work, to school, to kids' schools, to daycare, just to make sure that it's going to work. Not everyone finds their perfect house 5 minutes within work, school, daycare. And then consider the resale value, which can have a lot to do with the neighborhood, and it can have a fair amount to do with the particular property that you find as well. And you may have your own things to add to this, but these are some good ones. And again, if you take away nothing else, I would highly suggest you visiting your neighborhood at different times of the day, during the week and then on the weekend as well, just to see kind of what's going on there.
Okay, so you found that house that has most of what you need, and it's in a great neighborhood, and it's well lit, and it's safe, and you like it, and you've got your realtor. So now we're going to make an offer. Your offer comes with a lot of safeguards, and that's kind of what we're pointing out here, is you can make an offer on this property with some ifs, ands, or buts attached to it. Especially when you're doing financing on the home, there's some things you kind of need to have in there. So a home appraisal is always a big one, especially in a market like right now is very fast and very fluid, and people are making offers over asking price on a pretty regular basis. You still want to be cautious that you're not spending a fair bit more than this house is actually worth on the market. That if you move in there next month and something happens that causes you to have to put that house back on the market, you don't want to have to sell it for $20,000 less than you bought it for right off the bat. So your lender will also insist on an appraisal, and we're not going to lend you more than the house is worth. So it's important for you and for us to have a professional appraiser go into a house and give you a fair market value. As part of the financing process, that's something that we will take care of. You put it in the offer that you need to have an acceptable appraisal within X amount of days. We'll do that step. So you don't order that. We work with a network of appraisers, and we'll get that piece done for you. But it's an important contingency to put in your offer. Similarly, a home inspection is not required for most of our loan programs. I won't say all, because some do. And also some of the home buyer grants and things that are available throughout the communities will require inspections. But even if your home loan doesn't require it, I always recommend it. There depends on the size of your home. You might spend $400 to get this done. But even if there's nothing major wrong, it's a lot of peace of mind. If there is something major wrong, now you have the power to negotiate with the seller. if you don't get one and you move in and then you find out that you've got some substantial foundation issues that you didn't see or you weren't trained to see, that's your house now. You can't go back to the seller and ask them to fix that anymore. So we always recommend a home inspection. We can't necessarily require it. But again, very important piece of the process that will lead you in the right direction. And then also financial contingencies for your lender. So there's always a financing piece in every offer that says this offer is subject to getting approved for a loan of X dollars for this term at this no higher than this rate. So that kind of covers you if something else were to happen and something changes in your financial situation, or the appraisal doesn't come in and for some reason the loan that you were pre-approved for, situations have changed and we can no longer finance it. That gets you out of that contract without having to worry about legal ramifications from the sellers trying to enforce their contract rights. So there's all sorts of different things that can go into an offer as far as what property might be left with the home, if you're going to grant them, time to stay in the home after moving, or if you're requesting early occupancy to maybe move some of your things in. There's all sorts of things that can go within the offer, but these are the biggest and probably most important things that you just want to make sure are present in any offer that you make. Perfect. All right. Moving on. So you've got pre-approval. How do we get you fully approved?
So these last 2 or 3 slides we'll move through pretty quickly. I know that we have run out of time, and we want to save some time for questions if there are any. But essentially, like Amanda said, you were pre-approved, you found the perfect house, you wrote an offer, it was accepted by the seller. Now you need to get to the next stage, which is formal approval. And that will entail, we're going to order the appraisal to make sure that the home appraises out. Now you're going to start shopping for home insurance and schedule that home inspection if you decided to get one. And then, as Amanda had alluded to earlier, we're probably going to need updated income and asset documents. So we're going to need updated pay stubs, updated bank statements, because certainly it's easy from pre-approval to actual approval for weeks, if not maybe even 2 or 3 months to have passed. So be prepared to get all of the updated documents, and then insurance, appraisal, home inspection are kind of your next steps.
All right, so now we're right before closing. You've gotten us all those updated documents that we need. You'll be working with your realtor at this point to schedule a final walkthrough of the property. Make sure that everything is still working, that the faucets are still running, that your seller in the haste of moving out didn't, punch a hole in the wall with the leg of their couch, kind of things like that, just to do a once through to make sure everything is still looking good. Also at that point, you'll want to start making phone calls to switch utilities into your name, call your cable company, call the utilities, call the gas company, all those sorts of things, so that when you move in, you're ready to go. And then we will be in contact as your lender if there's any final conditions that we need cleared to get you to the closing table. So if you had some repairs maybe that you asked for the sellers to do as a result of your home inspection, we follow up on those to make sure those repairs are getting done and that they're getting paid for, and that we have proof that they're paid for, so we know that the contractors are all set and they won't bug you as the new homeowner. So those are the types of things that usually happen right prior to closing to make sure we're ready to go. There you go.
I get the last slide. Close, move in, and enjoy. So it may seem like there was a lot of information today, and there certainly is, but don't fear, we take you through it step by step by step. First is an initial meeting, and we're kind of there every step of the way.
Okay, thank you guys. We do have one question, and sometimes, actually, we have two questions that just came in. Sometimes people might be on the fence of whether or not they should rent or own their own house. Is there a certain time period? How many years should you plan on owning a house to really make it worth it? Do you have any guidance on that time frame?
Gosh, there used to be a number, and I don't even know if it's inaccurate as it used to be because of interest rates being as low as they are.
That's true.
You know, it used to be, what, 2 years, right? 2 to 3 years was kind of
You
the.
could recoup some of your money spent on closing costs. Is it better to rent or buy? I tend to think that that's sort of a personal preference as well. The allure of renting can be that you don't have to worry about a lot of maintenance issues or cutting the grass maybe or shoveling. You know, you have that landlord to help do that. Some people have that dream of home ownership. So if there is rent versus buy, and you know, like Amanda said, not sure that it would hold today with the way that rates have been and actually over the last few years, but a couple years,
Yeah.
two.
And it depends how much, if you're looking at paying $500 in rent or $1,200 in rent might really factor into. I think the biggest expense probably if you're moving quickly, you're saying this might be a 2-year place for me, is what does it cost you to sell that house? If you have to pay a realtor commission and then kind of do your break even from there, am I going to spend, you know, $12,000 a year in rent? Then maybe I can pay a 7% commission on this $100,000 house in 2 or 3 years from now, and you're still going to win. So a lot of that, there are some calculators for that online too, where you can actually plug in your proposed numbers of here's my rent payment, here's what I'd probably buy for if I bought at this interest rate. And there are some calculators out there that will say you need to stay this long for it to make sense.
Okay, we have one more question. If someone is currently in a rental lease and they have about 5 to 6 months left on that lease, how far in advance should they start the pre-approval process with the bank?
It's a great question. I might say it's never too early, but I will say that while we have reiterated we need updated income documents, updated pay stubs, your credit report that we pull is typically good for 120 days. So that's 4 months from the time that we pull it to the time that you would need to find a house and actually close on that home loan and go to closing that day. So if you're starting the process sooner than that, then I would say just expect to have that credit report potentially repulled. Because again, those are only good. They're good for a lot longer than a pay stub, but they're only good for 4 months. So you may want to try to time that a little bit. But then at the same token, I hate to make somebody wait. I mean, it's another credit pull. I don't know.
And we have people that have credit, I'll say surprises that something was out there that they co-signed on and the other person didn't make a payment, or somebody has a similar name and now they have a collection reporting that's not even theirs, but we have to deal with it now. So in that respect, it's kind of nice to get an early start. So if there's something out there that's got to be corrected, there's time to do that. When you're 60 days before closing and we're just starting to look at it, it's harder to take care of some of those items. So even that's a really good time, if nothing else, to start doing the Credit Karma thing and just say, what's out here? Is this all mine? Is this legit? Because that's the biggest reason for me that you would start early, is just to make sure all is well in the credit category.
Great. That's all the questions that have come in so far. Any callers on the line, if you have any additional questions following the webinar, you can always email BankFirst at infobox@bankfirstwi.bank, or just reach out to your local BankFirst office. We have mortgage lenders that are available at every office to help you through the process. Following the webinar, you're going to get a link to an email. We'll have a copy of the presentation, as well as a link to a quick survey. So if you do complete that survey, you'll automatically be entered to win a $100 Visa gift card. So we appreciate any feedback that you can provide to us so we can better inform you of other things to come in the format of a webinar. So thank you, Kat and Amanda, for your time, and everyone on the phone, thank you for joining us as well. Have a good evening.
Thanks for coming.
Thank you.